Our next guest thinks investors should brace for more pain at Tesla, but there's a long-term bull case to be made. Gene Munster is managing partner at Loop, and he joins us on the Fast Line tonight. Gene, great to have you with us.
Hi, Melissa.
What part of this goes away in terms of, the COVID situation in China and the Shanghai factory getting back up and running, and what part of this is just a more fundamental story about people not wanting to buy Teslas and Elon Musk's image being tarnished and Elon Musk being distracted at Twitter?
I think probably 80% of it goes away ultimately. You outlined some of this vortex of negativity, Musk and Twitter discounts, Shanghai shutdown, used car price in the macro, all of these I think are transitory. To use a Fed term, it can last a little longer than expected, and that's why I think as someone who is supportive and believes that this stock is undervalued here, I think that there still is some near term, and specifically very near term, is the market's going to be on pins and needles related to Tesla until January 1st when the December deliveries come out. The December deliveries are going to not capture the piece of this discounting. 7% discounting might not sound like much for the month of December, but that's going to impact profitability. And so you're going to have I think you'll see a sigh of relief on the delivery number near term, and then all of a sudden investors start to get nervous about what they're going to report in 3 or 4 weeks around the earnings. So we're not out of this. That's why I talk about brace for more negativity, especially given the temperature of the market, and it's a risk-off market. But I would ultimately come back to this question, and I forget which of the panelists talked about this today, but is this a tech company or a car company? And I think that, to me, is the bigger question. If you think it's a car company, you shouldn't own it. This means that they're going to have minimal market share, that their margins will go away, that other companies are going to catch up to them. If you think they have some sort of competitive tech advantage around manufacturing, whether it's FSD, batteries, that will yield higher margins than typical, and there's a massive a market that they're getting into. So, Melissa, 80% of this is a vortex over the next month. I think the bigger question investors should be asking here is this a car or a tech company? If you believe it's a tech company, I think you should own it here, despite what the stock is trying to tell us. I think long-term it goes higher.
Yeah, that question has been the sort of the existential question facing all investors for some time when it comes to this stock, Gene. But if you think that 80% of the problems for Tesla dissipate, how much of the market cap returns? How much of the multiple comes back?
I think if you think about 2023 and into 2024, I think, this isn't a stock recommendation, but I think that a lot of it does come back. It's right now, it's trading at 2.5 times revenue. That revenue number may be a little bit too high. I think Apple's good comp on the services hardware, that integration revenue. Apple's trading at 5 times right now. So I think you can kind of retrace. It's not going to get Apple's multiple, but you can retrace some of that gap. And I think, essentially what investors need to see is pretty straightforward. They need to see the delivery numbers. They need to see the profit numbers. We're a month away from getting both of those. I think once we get those and it shows that the line is still intact about the adoption curve, I think that the multiple can have some form of a rebound.
Hey, Gene, it's Steve. So I'm going to ask you what Melissa asked us. What do you think in 3 years out? I'm going to play Would You Rather in an A block, virtually unheard of, with Gene Munster. Would you rather Apple or Tesla 3 years out?
I would take Apple, and the reason is, to this idea that Apple is going to get into the car business. I think Mark Gurman from Bloomberg does a great job of covering this, and he's spot on. If you read his published work, he thinks they're going to do a car. If I'm not willing to say that right now, but if they do get into the car business, that probably has a positive impact. I mean, they could double their revenue over the next 10 years based on a car business. And you probably have some sort of competitive pressure on Tesla. So I think both of these are going higher. It sounds like out of touch with reality reason to own Apple. I think they have business, but I still think they're getting into segments that are far from priced into Apple shares right now.
Gene, just quickly, because we're out of time, if Elon Musk reduces his role at Tesla, maybe becomes chairman or something along those lines, does the stock go higher?
Yes, I think it does, just for the simple fact, it's reassuring to investors that he's putting his attention. I think that just helps investors sleep well at night. Investors sleep well at night, multiples go up.
All right. Gene, great to have you. Thank you. Happy New Year. Gene Munster, Loop Ventures.
Thank you.
Victoria, your thoughts on that very question. Is the company better off without an Elon Musk now?
I don't don't know. That's a tough question. I mean, he is Tesla. And so when you think of Tesla, you automatically think of Elon Musk. You think of the genius that he has and the innovation that he's brought. So I think that's kind of the competitive advantage that Tesla has right now. Does that wane if he's not there? Maybe, I'm not sure. I mean, I would rather see him reduce his role at Twitter, come in and take that that main role again over at Tesla and give some support to that stock. Like I said earlier, fundamentals aren't supporting the pricing that we're seeing. Maybe if he gives more attention back to Tesla and gets that innovative component back there, perhaps we see a little bit stronger fundamentals there.